So good afternoon students, welcome to my next video. Here we will talk about economic concepts part 2. I Dr. Rohan Prabhakar Devale welcome you all. So here more few fundamental economic concepts. We'll start with price, then competition, monopoly, profit, margin and average, optimization, elasticity and firm and industry. Very small short concepts we will cover in this particular video. First we'll start with price. Price refers to the amount of money which must be exchanged for one unit of a commodity. In other words, price is the value of a commodity determined in monetary terms. Price is the money measurement of the exchange value of a commodity. Example, price of an apple may be 2 rupees. Price of an orange may be 1 rupees and so on. Relative prices of two goods reflect their real ratio of value in exchange. That is, suppose price of apple is 2 rupees and orange is 1 rupees. Relative price you can say that one apple is equal to two oranges. The price of a commodity is determined by the interaction of its demand and supply. Thus, price depends on two factors. First is utility and second is cost of production. Apart from utility, basically a high cost of production would imply a higher price of the commodity and vice versa. Now, what is difference between value and price? Conceptually, value and price may be distinguished as we have shown on the screen. Value is a real concept. Price is a money concept. Value is a relative term. The exchange value of one commodity is measured in terms of another commodity. Like 1 kg rice is equal to 2 kg wheat. Or we have just taken the example of oranges and apple. Price is an absolute term. Price is the exchange value of unit of a good or a service measured in its absolute term through money only. Example, price of 1 kg rice is rupees 6 suppose. So here the absolute value will be 0 rupees. From 0 we are charging the commodity prices. Third point for discussion is value is expressed as the ratio of exchanges between two commodities. Thus, the value of one commodity is related to the value of another commodity in terms of each other. It involves comparison. Example, 1 kg rice is equal to 2 kg wheat. Alternately, you can mean that 1 kg wheat is equal to half kg rice. So price is just related to the money value of a particular commodity. Maybe rice is equal to 6 rupees per kg and wheat is equal to 3 rupees per kg. Value can relate to any quantity of goods such as 10 kg or 20 kg, etc. Price is always determined as per the unit of a particular commodity. Value of goods cannot rise or fall together in general. When the exchange value of one commodity rises, that is, another related commodity must relatively fail. So, take one apple equal to suppose two oranges. Now, if we exchange the value of apples rises in terms of oranges, then one apple may be equal to four oranges, which means a decline in the exchange value of oranges in term of apple, as one orange is now equal to one-fourth of apple against one orange was equal to half apple previously. So it is relative. Thus, the two values move in opposite direction. In short, all values cannot change in a uniform manner simultaneously. Because value is a relative term and it is the ratio of exchange. On the other hand, prices of all goods can rise or fall together. It is possible that the prices of pens, pencil, apple, bananas, oranges, and thousands of other commodities may increase or decrease at a given time. Thus, there can be a general fall or rise in prices because price is an absolute term expressed in money. Economists, however, refer to the value theory as the price theory, as price is a monetary equivalence of the exchange value of a commodity. Next concept we will learn is competition. Business managers are always concerned with the competition in the market. Degree of competition in the market crucially affects the business strategies, policies, profits of the business firm. Competitive framework is pivotal in determining the business goals and mode of action to be undertaken by the operating firms. In modern times, the competitiveness of the market is actually determined by the individual sellers or firm's power to influence the market price. Now, according to Lipson and Crystal in 2004, where economics in Oxford University Press, New York, they said that the market trends to more competitive when a firm will now no power has less power to influence the market supply and price. Apparently, when the firm possesses a high degree of power to influence the market in the matter of supply and price, the market turns out to be less competitive. By and large, the nature of competition as the competitiveness of the market is conditional by the number of sellers or firms existing in the market. As a matter of fact, larger the number of firms in existence, competition tends to be high. Fewer is the number of sellers, competition tends to be less. This is in general, not always this can happen. When there are firms and each having a zero degree of market power, the market tends to the perfectly competitive. For example, farmers in India selling their farm output such as rice has no power to influence in the market price for their produce independently. So the agrarian market through to be competitive, highly competitive, and the price is solely determined by the interaction of the forces of demand and supply in the market. Zero degree of market power implies perfect competition in the market. In this regard, economists usually mention perfectly competitive market existence in some of the cases such as a stock exchange market or agricultural output market. Now, what do we understand by pure or perfect competition? A distinction is often made between the pure competition and perfect competition, but this distinction is more a matter of degree than of a particular kind. For a market to be purely competitive, three fundamental conditions are essential. These conditions are: first is a large number of buyers and sellers should be there, then homogeneity of a product should be there, and a free entry or exit of the firms should be there. So for the market to be perfectly competitive, four additional conditions must be fulfilled. These four conditions are displayed on the screen. First is perfect knowledge of the market, then perfect mobility of factors of production, then third is absolute government non-intervention and no transport cost differences. So incidentally, the perfect competition or the term perfect competition is traditionally used by the British economists while discussing the price theory. While American economists, however, prefer to construct a pure competitive market model, realistically assuming the additional factors for perfect competition, such as perfect mobility of labor, perfect knowledge of the market, etc., may not be attainable. Perfect competition is fact is just a concept or suggestive norm or just an ideal market for structure. Pure competition sustains the norms of a particular competition without fully attending it. Now, as we are discussing about competition, there will be n number of players in the existence in a particular market. But what if the market is a monopoly market? So this is our next feature or economic concept, that is monopoly. Monopoly is the other extreme form of the market situation. Pure monopoly is just the opposite to the perfect or pure competition. Monopoly is the antithesis of competition. Under monopoly, a seller has the capacity to influence the price of its product for the sole supplier in the market. If the firm is a single seller, there is pure absolute monopoly. The degree of monopoly power tends to be less with the increase the number of sellers in the market. Pure monopoly market condition is in which there is only one seller. He controls the entire market supply of a product because there is no rival producing or a close substitute. The monopoly firm itself is an industry, so its output constitutes the total market supply. In a monopoly market, the seller, that is the monopolist, is faced by a large number of competing buyers. But being the sole supplier, the monopolist has a strong hold over the price determination. He usually tries to set the price and output of his firm entirely in his own interest of profit maximization. So ideally, monopoly market should not be there. Next is profit. Profit is the price of entrepreneurship. Profit is the reward earned by the entrepreneur for his or her contribution to the success of production. In a capitalist system, profit is the primary measure of success of a business firm. An entrepreneur is entitled to receive profits for his basic entrepreneurial functions, that is, organization of business, then bearing business risk, etc. Profit may be defined as the surplus of revenue over the cost of production. So, in symbolic terms, we can say that profit equal to total revenue minus total cost is the simple mathematical expression you can write about profit. So what are various characteristics of profit? Profit is the earning of an entrepreneur or a business firm. It differs from the other rewards such as rent or wages or interest on account. The following uh, characteristics can be written, and I will just explain them. First is profit is a residual reward. Profit is received by the entrepreneur as a residual surplus which is left over after meeting all the business expenses from the sales receipt. Profit is non-contractual. Unlike rent, wages and interest, profit is not a predetermined contractual payment. Therefore, it is not an explicit cost. Third is profit is the end result of business. Other factors or other factor rewards such as rent, wages and interest are received by their agents during the process of production. Profit is realized by the entrepreneur only after the completion or completion of the business, that is, after completing the sales and meeting all the expenses. Fourth is profit is not a fixed income. All other factors, incomes such as again rent, wages and interest are predetermined and fixed. Profit being a residual income cannot be fixed in a predetermined manner. Fifth, profit is uncertain and fluctuating. Unlike other factor of prices, profit is not a certain reward of entrepreneurship. It varies from time to time. It is conditioned by the business prosperity. Profits may be high during the period of prosperity, and profits may be decline during the recession period. There may be even losses during the depression or recession. Thus, while other factor incomes are generally stable over a given period of time, profit is widely fluctuating. Sixth is profit can also be negative. All the other factors, again, like rent, wages, and interest, are always positive, but profit is not always positive. It can also be negative, such as when the entrepreneur suffers losses in the business. Seventh is profit is not determined through a formal factor market. All the other factors are determined in a formal factor market. For instance, rent is determined in the land market, wages in the labor market, interest in the capital market. There is no such formal entrepreneurial market for determination of profit. Last, profit is a dynamic concept. Profit depends on many factors such as entrepreneur's organizational ability or changes in the supply condition, changes in the market demand condition, element of monopoly power or maybe competition in the market, various innovations such as production of new items, discovery of new markets, new modes of advertising, various sales propaganda, new entrants in the markets or new exits from the market, etc. So there are many dynamic changes in the economy. So profit is dynamic and constantly changing concept. So according to economic interpretation of profit, so the term profit has different connotations in accounting sense and in economic sense as well. So in accounting sense, when the total cost is subtracted from the total revenue or total sales receipt of the firm, the residual term is profit. So you can say that profit equal to total revenue minus total cost. In economic sense also, profit is measured as the same in the same fashion, but conceptually there is a sharp difference in its measurement. There is a distinction between the accounting and economic definition of costs. In accounting practice, when the total cost is measured, only explicit cost, that is contractual payment, made to different factors input by the firm, are considered. These include wages, salaries, expenses on raw materials, fuel and power, rent and interest. So these inputs, cost of depreciation charges are also added. In economic sense, when the total costs are measured, we include explicit as well as implicit costs. Implicit cost refers to costs which are to be deemed and imputed as costs. When a firm uses its own capital for which obviously no interest is payable to anybody. Similarly, entrepreneur provides managerial services for which he does not receive any remuneration by the way of salary, for which functional work rendered by the entrepreneur, therefore, we find implicit wages, implicit interest, and implicit rent included in the cost of production. Thus, we can say in the economic sense, profit is equal to total revenue that remains same minus total explicit and implicit cost. In this way, in the economic sense, profit is looked upon as a surplus, that is surplus of the firm's total receipt over its total cost, explicit plus implicit. So another term, gross profit and net profit. So in ordinary practices, in ordinary parlance, the profit actually means the gross profit. It is the surplus of total revenue over the total money expenditure incurred by a firm during the production process. Gross profit does include many items of input, service, and other miscellaneous costs, so it cannot be regarded as profit in the real sense. Thus, though profit is a residual income, the whole of it is not pure economic profit, which is a return for the risk-bearing function of the entrepreneur. Gross profit includes various terms like imputed cost, implicit returns, normal profit, non-entrepreneurial profit, and net profit. So imputed cost. What are imputed cost? Imputed cost like maintenance and depreciation charges to arrive at net profit. These are to be deducted from the gross profit. Next is implicit returns. Implicit returns such as implicit rent, implicit wages, implicit interest for the factors of land, labor, and capital, owned by the supplied by the entrepreneur himself. In many business firms, entrepreneur uses his own land, invests his own capital, and also he himself works as a manager. Third is normal profit. Normal profit is also the implicit cost of entrepreneurial inputs. It is the imputed minimal return for the entrepreneurial's organizational function. Fourth is non-entrepreneurial profit. It includes windfall gains, monopoly gains, etc., which occur to the entrepreneur as a result of change in the events and market imperfections. This profit element is not related to entrepreneurial ability in the strict sense. Last point is net profit. It is the pure economic profit earned by the entrepreneur for his services and efficiency. Now we have a few formulas listed or given in the screen. First is, in short, we can say gross profit equal to net profit plus implicit rent plus implicit wages plus implicit interest plus normal profit plus depreciation and maintenance charges plus non-entrepreneurial profits. Thus, it follows that net profit equal to gross profit minus all the things. So, indeed, net profit equal to economic profit or pure business profit. Next concept is margin and average. In the concept, uh, in the concept of margin is fundamentally used in economic thinking and arriving at the right rational decision. In economic science, the term like marginal utility, marginal buyer, marginal cost, marginal revenue, etc., are used in a pivoted sense. Margin refers to the last in the total or an extra into the total. For example, if buyer buys 4 apple, then the fourth apple is taken as marginal. Likewise, in a given total of 4 apple, when an additional is made by one more apple, this extra one is considered as margin. So, in measuring the cost, therefore, the additional mode of total cost by the cost of producing an extra unit of the product is considered as marginal cost. So, uh, what do you understand by average? Average refers to the total value divided by the total number of items. So thus the average cost, that is AC, for instance can be measured as total cost, that is TC maybe, divided by Q, that is total quantity of output. So the normal way we calculate the average. So total cost divided by total output will be your average. Then next simple concept is optimization. The equimarginal principle is fundamental in economic analysis. It is very significant in determining optimal condition in resource allocation. According to the equimarginal principle, a factor input should be employed in different activities in such proportion that its value of marginal product is equal to or may be the same in all the uses so that optimum level is reached. So labor cost is minimized maybe in one particular period when with that particular reduction in the labor cost, the ultimate output is can be possible for manufacturer. Next is elasticity. The term elasticity refers to the degree of responsiveness of a dependent variable to the change in determining variable in an economic function. So suppose for example in a given demand function, d is equal to function of p for a particular product, where d equal to demand, p is equal to price, and f denotes the functional relationship. Suppose price increase by 10, where demand rises by 20%. It implies that demand is highly responding to the changes in prices. So concept of elasticity is widely used in managerial decision making. Last concept is what do you understand by firm and industry. We have seen in monopoly, if monopoly market is there, then that particular firm is nothing but the firm is called as industry. So firm and industry are the basic concepts in the price theory. In economics, the term firm and industry cannot same spatial meaning connote the spatial meaning than what it is understood in the common parlance. So, what is firm? So, firm refers to a business unit, an enterprise undertaking the production of any commodity, or maybe that firm is delivering services. In economic theory, the term firm connotes a particular production unit. It symbolizes a unit of control over a group of factors of production coordinated for the purpose of producing a commodity. A firm may be a small one or maybe a large one. The term small firm refers to a single plant, factory or business or retailing unit which has a small capital investment producing small quantities of a product per unit of a time. On the other hand, a large firm is one which has a number of plants under a complex managerial organization with a diversity of financial capital investment which may produce a wide variety of products in a large quantities per unit at a particular time. Now, what is industry? Industry. The term industry refers to a group of firms engaged in a production of a specific commodity. So we are saying like banking industry or telecom industry or retail industry or retail sector like that. So including all its close substitute. Thus, an industry is a set of firms producing homogeneous products. Here, the term homogeneous implies similarity of productive activities, results and satisfaction of similar wants by similar kind of goods. Thus, there are firms which are engaged in same type of production or similar type of production. All these firms together constitute the industry. The firm's production plant has a specific location. The industry is spread over a wide region. In short, a firm is an individual productive firm. An industry is a set of all such firms, maybe big or small, engaged in identical productive activities. In fact, grouping all the firms, big and small, according to the most prominent characteristics that they are, have and common constitute as an industry. In this way, an industry may be considered as a classification of a number of firms having common characteristics in regards to the production activity. So, a few important questions for this particular topic is you have to define the following concepts like define demand, define supply, define production, and define distribution, or write some short note on consumption, consumption function, cost, price, competition, and monopoly. Then maybe a question like what is profit and what are the characteristics of profit. We have seen 8 characteristics and explain the technique of optimization. So these can be few questions